Good morning, traders. Welcome to the Flow Show. We write July the 2nd. We are Wednesday. Before we start the headlines, let's run over our big announcement that is coming sometime later this year. And you can still put in your name if you have done it already. No need to do it a second time or a third time. Bran, I'm looking at you. No need to subscribe every single every single day. We have your email. Don't worry, you are enlisted to also take part in a sweepstake where the people who have put their name and email down can win one of two trader funding programs this month. And so if you haven't done it yet, subscribe, and that will also give you the heads up before anyone else on the on in the wild open about the changes that are afoot in our community, and they are big changes, I can tell you that. Also, I'm going to be your host for today. Ryan can't unfortunately be with us today. Hopefully he'll be back tomorrow, but I will be hosting the show. And as I said, there is those TFPs to be won, but at the same time, we are doing a big promotion that is you can get 30% off any trader funded account that of your choice. We have two choices, as you know. There's one with a two-step and one with or one-step onboarding, and the other one a straight live funded account. And from the 3rd until the 7th of July, and only those days, okay, we are going to give 30% off to anyone who enlists for either a live trading account straight away or the assessment to get a live funded trading account then once succeeded. I am just putting the link that you also can follow to get access to those traded funded accounts. Okay, so that's the thing that's upcoming. 3rd till the 7th, so it starts tomorrow until Sunday. You will have 30% off any trader funding program. Okay. Right. That being said, let's move on to what has happened overnight, what has happened yesterday. And actually, in the real headlines overnight, there's not that much news. We can talk about a lot of stuff, but the fresh headlines are not really, there's not really a load of French headlines. We Let's kick off with how it's happening between US and Japan, and they seem a bit on a slippery slope there from both sides of the negotiation table. They don't want to give in much. The Japanese are constantly asking, obviously, for those auto tariffs to be potentially replaced by quotas. But Trump yesterday wasn't happy at all about Japan, and where in April he was threatening to slap 24% on all Japanese goods, he's now talking about 35% if the negotiations won't go the way he wants. And Akazawa is actually going to the US for the, I think, eighth time or so next weekend to try and get a sort of a deal together before the 9th of July headline deadline, which Trump actually confirmed. We don't know what exactly the 9th of July, what exactly will be decided. It could be skeleton trades, it could be full trades, maybe India is going to be done. But anyway, he confirmed the 9th of July as being some sort of a deadline still, as he originally said about those 90 days. And in the meantime, as I said, on the other side of the negotiation table, Ishiba was talking again, saying that on the demand for defense hikes. He will and Japan will decide on the increases in the defense budget itself and not the US. And they will also boost the domestic demand and expand to other destinations if auto exports to the US are set to drop. So as we can see, nothing is done over there. And as we've already many times said, it should have been a show in this US-Japan, should have been the easiest deal to be made. But the people around the negotiation table are not of that mean right now. So they continue to play hardball, and it does. If we look at some of the yen pairs, it does affect the yen just a little bit. Also, remaining on the trade side of things, the EU also toughened their positions a little bit. They asked to reduce the 10% reciprocal tariffs and also the sectoral levies before going back to the negotiation table and trying to clinch a deal. It does appear that the EU is not in such a hurry to respect that 9th of July deadline. And being such a big bloc, I wouldn't be surprised if there would be some sort of just a preliminary agreement to continue to talk, but not set before the 9th of July. Um, and then I think I'm done on the US side of things. Yeah. The Brexit isn't dead either. It's still very much alive because now the EU has blocked the UK access to a pan-European Mediterranean trade area. There is still no agreement, and that is really what's been going on since Brexit. There is still no agreement on EU blocking powers over all kinds of stuff going on, and then I'm especially thinking about fishing quotas and stuff like that. But EU has always hammered on the fact that in any deal with the UK, they should have some kind of blocking powers on some aspects of the deal. Obviously, UK does not agree with that, and so the EU went on to block the UK's access to this trade area, and I think that is one amongst the several reasons why the sterling is losing a bit of its shine right now. Um, what else? Okay, before moving over to all the central banks, yesterday we saw an announcement that the US major banks are going to raise their dividends and are going to announce big share buybacks. JP Morgan was talking about up to $50 billion of share buybacks because they have been emboldened by the relaxation of regulatory environment, sorry, um, more relaxed stress tests as well, and they decided that they would embark on a pretty steep dividend hike and a very big share buyback. So that is one to keep an eye on when you look at all the banking shares for the people who trade stocks, obviously. Right, over to central banks. First of all, Besant yesterday said that the Fed could start to lower their interest rates by September because one of their criteria being the inflationary pressures of the tariffs. It is, according to Besant, of course, it is now showing that that inflationary pressure may not be as hard as the Fed may have feared, and they should be starting to lower their interest rates from September. And talking about those interest rates, yesterday we had that meeting in Sintra, the ECB meetings, um, where we had Powell, Lagarde, the Korean central banker, Ueda, and the fifth wheel on the cart, Mr. Bailey as well. And had their chat. They tried extremely hard not to give the markets anything, Lagarde said that they are sort of where they want to be. The Korean central banker said that they are still feeling some stress about everything that's going on, trade deals and with China as well, and they also fear for more potential pressure on their growth outlook. So he was rather pointing at additional rate cuts. Ueda still very cautious. Yes, acknowledging that the headline inflation has been running above their target for of 2% for nearly 3 years now, but he said that the underlying inflation is still not where he want it to be on a permanent basis. So he keeps the cautious stance regarding interest rates hikes over there. And then Powell spent most of the meeting also trying not to reply to whatever questions were fired at him, but he did let slip something where he did not completely close the July decision on the rates, and that is kind of a continuation of what he said the week before when he was at the committee hearings, and where he said that for the time being the data were not supportive of doing anything, but things could change and could evolve um, in the next few months, if not weeks, if data would warrant it. So that's a little bit of an extra that he gave us yesterday. Not that the market, well, paid attention to it more than for 10 minutes or so, but he did drop that line, so that pushed the market at trying to price in a little bit more of rate cuts for 2025, but as they all confirmed, they are all very, very much data dependent. Those are really the two words that stand out of there. And then, as I said, Bailey was just there to fill up the fifth chair. I'm not even going to talk about him. He didn't really tell us anything useful at all. We had more ECB bots. They just can't shut up these days. We had more ECB bots out. Mueller yesterday, the main thing that he said was that the ECB now can wait. Ren, who used to be an Uber Dove, he said that they have to be mindful of inflation staying persistently low. That's a bit of a 180 over a couple of months' time from our friend Rain at the ECB. So he seems to be keeping the door open. And Wunsch just came out saying that the ECB should support a mildly supportive stance also because of this inflation. Centennial, though, who will be out in a few months. But he said that, and he used to be the Uber Dove at the ECB, now changed his tack a little bit. He did say that the weak second quarter risks of too low inflation, but what he said before, and that is what De Guindos, Lagarde already said in as many words. He said that the strong euro brings more investors to Europe. The markets decide on the level, but they welcome all those investments into Europe. Himself is not in a rush to lower interest rates for now. Okay. All right. And I think in kind of headlines that would have been or could have been market mover, I think we have already done the rounds there. So let's move over to what has happened on the data front. And yesterday afternoon, we had a bit of data. The ISM came out, sluggish on the new orders, sluggish on the employment, but the overall George was not really dropping too far away, even actually half a point higher. But we can see here that the prices remain stubbornly high. We then had at the same time the jobs opening report, and of what I read, the main analysts are all scratching their head as to how and why this number all of a sudden came out a lot higher. It is attributed to big openings in the leisure department, and that pushes the analysts in saying that it is going to be a temporary factor, that overall the jobs market is still cooling a bit. So they think that this number that we saw yesterday was a kind of a blip. Okay. We will see what happens, because obviously today we will have the ADP, we will have the challengers job cuts, we will have a lot going on, and then tomorrow, obviously, cherry on the pie, we will have the NFP report, which obviously is going to be the one that everybody's waiting for. Although we have already said that the biggest changes may be expected on the basis of those government layoffs, may be expected only for August and September. But still, all those data will be important now, because the market is really scrutinizing all those data to see whether there is a chance that the Fed may go early, despite inflation being a bit sticky. And this is also my opinion. If the job market cools down further, I think it will push the Fed to cut earlier. But obviously, we will have to look at those numbers. What else did we have? We have a bit of mix manufacturing PMI. Yeah, the mix corrected a little bit yesterday, just in line with all the dollars basically. And then we came over here, this Atlanta Fed GDP now, the 75th revision, and we've got another 158 to come. So don't really hang your hat onto that kind of number. Bit of a build instead of an expected draw on the API. We will have the EIA numbers today. Not that they have impacted too much on what is happening in oil right now. We're rather looking at demand and what the OPEC is up to. We've had some Australian data out overnight. A bit of a how shall I say, contradictory one in the construction index coming down quite a bit. Manufacturing index was also down quite a bit, but then the building approvals on the year are still showing a relatively decent number. They were slightly below the expectations on the month-on-month, but getting back into the positive after a deeply negative month last. What did it, or what should have done it, I should say, for the Aussie was a relatively weaker than expected retail sales, been flatlining really. 0.2% is nearly flat. But the Aussie hasn't really been under the cosh too much from it, relatively speaking, to other currencies, if you take away the dollar part of it. This morning, bit of employment data in Spain. The Spanish are still the lot that are really doing a bit better than the rest of the main European countries anyway, because then we see that the Italian monthly unemployment rate had a pretty steep jump. Also, the European employment rate went up 0.1%. Not a big move, but it is not coming down more right now. Let's put it that way. Uh, it is something that it's not the price stability is the main mandate at the ECB, but we know that it's one of those unwritten sides of their mandate, that they look at growth. And obviously, employment rates and global employment is part of the growth picture in the bloc. So let's keep an eye on what's happening over there. What's happening next? So as I said already, we were going to have some mortgage data, then the challenger job cuts. That has been a bit of a jumpy one of late. We can't really say exactly what the next number is going to be, because it's really been bumping up and down over the past month. We had a pretty a steep jump here back in April. Then the number has been cooling down a bit, but as we can see, it tends to jump around a little bit. This is not unless there is something really fishy going on in there. Not going to be your main number, nor is ADP, but ADP still has those algos jumping around a little bit. It's not um, an outlook for what can happen on the NFP, but if we see a persistent low number here, imagine that we get a number which is closer to this 37K compared to the 100K expected, we may see a little bit of a wobble in the dollar. Inversely, of course, if this ADP number is starting to grab back, and let me get on a tighter scale, grab back all those higher numbers in the well up above 120, 150K, then the algos will probably be pushed to buy a few dollars on the back of it. But on the tip of my toes for this one, because obviously tomorrow is going to be the big one. And then we have the EIA oil inventories out. What do we have tomorrow? Tomorrow is also not only US jobs data, but we have the services PMIs coming out for June. The European, French, etc., will be the final ones, but we will have the Aussie numbers. We will have the Japanese numbers as well. We will have the Chinese Caixin services PMI out as well, and we will have the Swiss PMI out. We've been musing about that in our room because we do have a bit of is it hopium? Anyone tell me in our room whether it's hopium? Of course, there's a part of hopium in there, but Swiss data have been really weak of late. Yet the Swiss franc is stubbornly high and stubbornly keeping its beat. Even now that we are over the hump of the month end and start of the new month quarter, the Swiss is still holding its bid for now. So yes, as I said, the rest of the PMIs also in the UK, and then tomorrow, obviously, but we will talk about that tomorrow, the big expectations, what is going to happen with that US jobs report. That's it for the data outlook. Let's move over to prices. What have we seen? Well, we have seen yesterday that push up into fresh highs in most of the currencies versus the dollar, followed by some corrective activity. And we've been talking about it on the once, as I said, once this start of the month is over, then we're probably going to have a look at what is going to happen next. And next are those tariffs, obviously next week. But then we have this employment part of the market that the market will be looking at. So it is not abnormal that we corrected a little bit. It's a consolidation right now, okay? For the time being, there is absolutely nothing going on. Yes, we do, and we are not too far away, and we could even have a look below it if we want. I'm on a shorter time frame, so the longer time frame does show obviously this mega importance of the 117.5, but I really would and even we can start from before here, the whole of 2025. If you look at all those levels and all those this whole move, we could hardly say that even a move below 117.5 would be life-changing for the euro dollar. It will probably shake out a few of the latecomers, as we say, but I would argue that there's much more, and I'm thinking about this zone here. For the more medium term, there's going to be much more going on if we get back into a zone which is around, let's say 115, 115, 116 and a half. But in the meantime, there are levels to trade. 117, 45, 50 is the first one. Expect a bit of a range until the ADP come out. That's exactly what we are doing. Nothing has changed. It's quite a stepping stone if you look at it from the longer term. It's quite a stepping formation, and each step has seen a bit of consolidation, the bigger ones, and then we are going on to the next step. And that has not changed, okay? So just for today, 117.45.50. If we break below, perhaps a bit of a run, run for the exit for the shorter termers, down to 116.80 or so. But I wouldn't think that any of the challenger jobs or ADP will change the overall picture. Actually, on the contrary, if they come in, let's say both week, we may see actually a bit of a continuation, and then the euro dollar starting to push up to higher 118s, 119s, let alone speak about the bigger trend line coming in just around above 120. Okay, so for the longer term, nothing has changed so far. Um, I'm coming back to your comments later, Ali. Okay, I've seen it. Sterling is a slightly different story, in my opinion, because, and I'll show the euro sterling. Sterling, and I warned about this, has lost some of its appeal. There are a few reasons for that. First of all, we have a more cautious Bank of England. Secondly, and don't underestimate, I mean, don't trade them per se, but just keep them in mind that this UK trade, whatever, with the EU was looking a lot better 2 weeks, a month ago, but now this EU blocking UK's access to this PEM is perhaps not the best thing that could happen. And then as well, and we've been talking about that, the British politics, and the market is now starting to be a bit cautious about the fiscality. Reeves has difficulties to convince investors to continue to buy the pound because they think that some things may go awry on the fiscal front in the UK as well, and that is why the sterling is losing its appeal. So we've moved relatively quickly in line with the rest of the dollars through this 137.40 area. There is a bit more weighting on top here around 138.15.20, but we shied back. And this is already a bit of a bigger give back than what's happening in the euro in comparison. And any supportive dollar news data I think would weigh more on the cable than it could weigh on the euro. So we have a bit of a support zone here, which held the last time before we had the last leg higher around 136.75. Then we have, this is the prior low. I haven't adapted it yet. We could put it higher, and then we come out at around 136.90, right where we are. So this 75.90 here is going to be the support. Then a bit of a trend line support around 136.60, but I would argue the more important one is around 136.20 right here and now. And again, if we get supportive data on the US, this is rather a pair where I would be cautious because it's, in my opinion, one of those that could see a more rapid decline than, for instance, the euro. And why is that? Because euro sterling is pushing higher. And we've been talking about that. I actually thought sterling would be in demand for the end of month, but actually it wasn't. So I did not keep my positions there, and luckily I didn't. Stepped out where I was roughly where I was short. And since then, since I have been a bit more cautious, this euro sterling has been gradually moving up. It's trading in a bit of a wedge. We are now trading already through the 61.8 of this move, which is the April-May decline in euro sterling, on our way to the larger one. I should really clean up and adjust my charts a little bit on the larger one, which is the 61.8 of the whole 2023-2024 decline. Okay, and that comes in at around 86.15. We also have another one here around 86.20, and that's where the top line. Well, I mean, it comes in closer now. It's just above the figure, but I think it may just, you know what, continue to creep higher up to 86.15.20, the way this is trading now. Maybe not that explosive unless really the market loses its confidence completely in the sterling, then in that case we can go pretty quickly up to 86.20, and there we will have to see what we do with it. Okay, because if that breaks, then I think we could actually go pretty quickly up to 86 and a half, and why not a retest of 87? For the time being, I'm not as bullish on the sterling as I may have been past months. I'm really actually relatively cautious on all things sterling right now. Okay. Yen. So the what's happening next? So as I said on my European update, it's been a case of the dollar decline, hope for a swift resolution of the US Japan trade deal, but it is not happening, and as a result, um, we're creeping back up in dollar yen, and this is mainly helped. Well, the dollar is making a little bit of a comeback versus a lot of currencies, but also because of this trade deal, and the crosses are still supportive. Suffice to look at the euro yen to note that the yen is still not really supportive. Even sterling yen, sterling which is now much weaker than the euro, even sterling yen is still trading above 197. And I think that just shows us that the yen is not really strong right now. Yes, we had a big technical rejection here and that came down, but that is now done. And I would say that any retests on weak US data, we will have to see if it really can break down. It can, but if it depends only on yen crosses right now on a neutral number, I don't think that this is going to be the best short dollars. Now, on the tip of my toes, obviously, because the yen is what it is. If they find a resolution of the trade deal, then we are going to trade lower levels, in my opinion. But before that happens, it doesn't look great, and the market needs to build in a bit of caution on what's happening in the yen right now. I'm going to give you again a slightly different view on what's happening in the Canadian dollar. Okay. Um, I know people are not having a lot of confidence in Canada. I don't really have a lot of confidence in the Canadian dollar as such, but this was my longer term view, and I always said like somewhere between 137 and 138 is a big zone. Well, what happened is that we went back up to close to 138. We went back up twice into the 137 and a half, and we are still rejecting it. This is in my opinion, still a big zone, 137, 138 on the dollar cat. And for as long as we don't break above 138 anymore, when it'll break, it's going to be a reversal, in my opinion. But for as long as we don't break this 137, 138 zone in dollar cat, I still think that there is this possibility in the medium term that we are going to have a visit at 134. Just to give you a different look at what could happen with the loonie. I know that a lot of people are not having confidence in the Canadian dollar and therefore buying dollar cat. Is dollar cat really your best instrument to do it? I may For the look that this has, in my opinion, it may not be the dollar side that we trade on the Canadian dollar. But if you want to be short Canada, perhaps looking at one of the crosses maybe it's slightly better. Aussie and Kiwi. Aussie stopped dead on trendline resistance at 65.90. We are still above the break zone 65.35.50. But same as in the rest of the currencies, we are in consolidation mode. And now we will see what's going to happen there. So 35.50 is still your zone to watch on the Aussie dollar, but don't forget the 65, the figure, okay? Because if you look at the global picture, even if we get down to 65, the figure, and it holds, nothing will have changed. We will still be in an upward channel or wedge, how you may call it. So keep that 65, the figure, in mind as well. If we break back above 65.90, then I guess we are going to have a look at 66 and a quarter and maybe even higher. Because I think from where we are now, we are waiting for what's next to happen. And if the next to happen is weak dollars, I think they all will go in tandem again at various speeds, but they all will go in tandem again. Kiwi did roughly the same thing. We actually had a little overshoot of this level. I was thinking like low 61s. We went up to 61.15 or so, but we're also shying away. There, same zone, 60, 35, 45 to have a look at on the day. If it holds, still all very, very positive. But even if this line breaks, and if you look at this move here, I'd still argue, and a bit like the same thing in Aussie dollar has been the same thing. Obviously, people will have a look at 60, the big figure, as being a bit psychological level, but I would use also the 59.70 as being perhaps even a bigger level than the ones here, because we always look at those short terms, and then if the especially if the line is steep, it could easily get down and then come down to here and then start to ramp higher again. So something that I um, something that I am going to keep an eye on as well in the Kiwi. Gold, I think we it's big again, the range, isn't it? But I would say that we're also going to wait here and now for what's to happen next. It did surprise me that we did $100 so easily. Um, but I still would say that we have to wait. If the 9th of July comes, and if by the 9th of July, and I think we are going to hear over the weekend, we are going to hear on the next Monday as well, before the 9th of July deadline. Um, if the 9th of July comes and goes and there are no trade deals, this is going to really start to ramp higher again, right? Um, because that will be bad news for, I guess, at least for that bit of the risk side, that will be bad news. If we get juicy trade deals, but let's now be a bit looking at it cool. It doesn't look like, apart from a few countries, the deals are going to be very juicy, because we hear from the EU, we hear from Japan, um, we hear from different countries that they are not willing to really give in to everything that Trump is asking. So I say we may run into rather skeleton trade deals and then renegotiate all the rest, and perhaps a bit of an angry orange hurricane over in the States. So perhaps this one is going to, well, I would say rather finding bids on dips and perhaps push against these 33 three quarters or even 34 again before we even get into final decisions on trade deals. Um, Silver, nothing changing. It's also hopping up and down. Still looking at prints in the 35s are still getting bought again this morning. The big one is of course going to be around 35, the figure. Okay. Now, what are you talking about, Ali? Let me just read this. What should a fundamental trader do in this scenario? On the one comment from Trump market is going on the one side, and one comment from Powell market is going on to the other side. How do you manage trade these days? How you change assets or stick to plans? I'm not because of very international behaviors. Okay, you know, as you can hear from my comments, Ali, I am sometimes changing assets or changing currencies as well. Now, for the time being, I'm still a bit long euros, but I've given up being long sterling. I've also stopped being long Aussie and the Kiwi right now, because I want to give myself a bit of room. But I always look at and I've been talking about it. I always look at, let's keep it simple. And if you talk about the dollar, I'm always looking at the other side. I'm always looking at the one that where I think, and I've been wrong in the past, and I'll be wrong in the future, but where I think that it has the best chance to perform the better against the dollar. For instance, if my bias is short dollars for the time being, with the inflows that we are seeing into Europe, I know the data are not specifically supportive. Maybe not even interest rates are specifically supportive, but the differentials, even if it come back, and if you look at it, you can overlay the euro dollar again with the short-term interest rate differentials, but they have been tightening. Okay, so they are still kind of supportive for the euro. And for the sterling, for instance, why have I given up? Because of the reasons that I gave you even on 5 minutes ago. The the attractiveness of the sterling is probably a bit less right now, so I've decided not to keep the cable on the antipodians like the Kiwi and the Aussie. I'm a little bit less positive still than compared to the euro, but I won't refrain on entering there, even if they all have their sensitivity to trade deals. I would argue that potentially Aussie and Kiwi may come out of it kind of okay because they have other outlets like China and Japan as well, right? Um, so they may be doing a little bit better. And so you see, and then if you move on to stuff like oil and silver, um, as you know, for me, oil is a hedge against stuff that can go bad, right? So that's why I'm always keeping an eye on what's going on in the world. And if I don't like what I see, if it comes combined with perhaps a bit weaker yields everywhere, it's going to push me to buy gold, for instance. I haven't done it right now because I didn't know what was going to happen, and as I said over the show, I've been myself a little bit surprised about $100 um, rebound that we saw so quickly. I might be looking at any weakness unless it's driven by really nice trade deals everywhere. I may be looking to re-enter a bit of a long, but for the time being, I feel a bit more confident with my long-term silver still because that is holding those levels. And silver, as I've been saying already many times, it has a better it needs a better environment, but it also, and I'm thinking about that is not really a good thing, but like reconstructions after war and things like that, they are going to need this as well. They are going to need silver too, and the supply in silver may not be there for every need at all. And also technically, it's been holding extremely well off late. So that's a bit how I switch from asset to asset. Um, and then Ali, yeah, I sometimes do trade indices, but I've been extremely busy on other stuff and on my FX positions as well. I have not been really trading indices off late, just the occasional little punt here and there, but nothing to really. It was just like more like jobbing. Haven't been really involved in a lot right now, but for the rest, it's prices, right? And price action, Ali. What is going to decide whether you are staying in a position or not? Like for instance, um, I did take actually my medium term euro dollar off at one stage, but I re-entered it yesterday at 117.65. So I still want to have a part dollar shorts because my overall bias hasn't changed yet. But the rest is just prices. You get your levels correct. And again, charts are adaptable at one stage because we are doing fresh highs, fresh lows. So you need to adapt them at some stage, but you still keep your main levels in mind. And for as long as they don't break back to worse levels than where your position also is, I mean, then you just keep your position going and you slice and dice like I'm doing and like Ryan is doing. And then Ayaz, why is free string going one way string to string, no replacements? We've been talking about that already many times. It's a bit of a mystery. Just And I know that mainly the accounts that are held by foreigners in Switzerland are not in Swiss franc, but somewhere they may have to go via Swiss deposits. But don't forget that Switzerland, not as much as years gone by, because regulations have changed, is still a parking place for a lot of money, okay? Because the secrecy of the banking account still not completely gone. It's still a parking place for money. But on the other side, the fundamentals are not Swiss supportive. And really they are not. I'm a bit short Swiss franc because I mean the levels are getting attractive. Not really on the dollar, I don't know, because it's I mean my bias on the dollar hasn't changed, but I'm the levels on Euro Swiss maybe are relatively attractive, and also I'm doing Euro because the outlook for the Euro is still kind of okay. So I prefer doing it in versus the Euro right now. And Ali, this brings back to your question: Are you changing assets or currencies? Well, I prefer the Euro in this case than the dollar Swiss because the dollar is still not on my shopping list right now. So there is stolen money. Come on, come on. uh, yeah, maybe stolen money from the crypto society. I'm going to say, but yes. So this is a bit of an explanation how I choose which currencies, which instruments I want to be in, and with that. Ladies and gentlemen, let's call an end to today's show. Thank you all very, very much for being with me today. We'll chat it tomorrow again. Don't forget, for those who haven't done yet, to put your name and your email address on that on our webpage, where you will get updates on all new things coming in the Forex Analytics community. Thank you very much. Have a very good day and trade safely. Bye.